Max Keiser. This is the Keiser report I just read somewhere. There will be fear. Ooh, I wonder what this means, Stacy. What does this mean?
There will be fear. Well, we've been, of course, talking about this for a while, saying that this the signs were there, that it was coming. And now Cathie Wood, the CEO of ARK Invest, is saying the same thing. She said this on CNBC. But you know, she's talking about the fear coming as rates rise, that the rates are going to start rising and fear will descend. And, you know, as human beings are organisms in a group, of a collective together, operating in society, you can see it in their sort of actions, like when fear is coming. And some, like powerful big investors, know stuff is about to happen and they start moving suddenly. Like, suddenly there are all these Wall Streeters and hedge fund guys fleeing Manhattan and running to Florida, right? Then you see the elite on the Beltway media, for example. They're starting to vibrate in nervousness about the people. The people no longer have faith in them. We must stop them from communicating with each other. We need to shut down websites. We need to start looking at like Telegram or Clubhouse where they're talking to each other without us listening in. So you're starting to see actions like that around the edge.
Yeah, you know, there will be fear, and the fear is omnipresent. It's always a situation where there's fear, going back to millennia, to the beginning of life on Earth, because there's always a threat to life. And then you have institutions that evolve to mitigate that fear, like political institutions or social institutions. But occasionally, like the animals running away from the ocean during the Boxing Day tsunami, they sensed the tsunami was coming. The humans on the beach were like, what's going on? What's happening? Meanwhile, the elephants are like hightailing it. We're getting out of here. And so the vibrations are in the air. The hedge funds are leaving. The people are panicking. They sense that the seismic bond reversal is at hand. The 40-year bull market in U.S. Treasury bonds is on the edge of collapse. This is the biggest thing to happen in markets in a century.
You know, we've also been watching this Adam Curtis series, his latest series. And one thing that humans do throughout the decades as well is the powerful people blame the people and the people blame the powerful. So there's going to be a lot of blame going around very soon. And you see that already starting to organize itself especially with the media, the elite media versus the people. But here we're seeing ARK Invest. So if, you know, there is no market more controlled than the bond market since the central banks, since the Treasury destroyed, annihilated, and slayed the bond vigilantes back in 1994. Again, that thing goes back to Hillary Clinton, right? Like they destroyed the bond market, the bond vigilante, because they dared to say no to Hillary Clinton and her. She wanted to have basically like an Obamacare back then, and they couldn't. Basically, her husband's government couldn't because of the bond vigilantes. They've been destroyed since then. So here, the bond vigilante, like if bond prices start to rise, well, this could be the ultimate Adam Curtis film one day. So Cathie Wood, just so you know, she founded ARK Invest, and she was a big, very early investor in Tesla, big, very early investor in Bitcoin as well. So, you know, she was there way before Paul Tudor Jones in terms of the investment space. She was there, and she was on CNBC. There will be fear. ARK Invest, Cathie Wood warns of stock market correction. She said, quote, "I do believe if rates were to take a sharp turn up, that we would see a valuation reset, and our portfolios would be prime candidates for that valuation reset, of course." So she's talking about our portfolios, the ARK Invest, which is heavily invested in tech stocks and stuff like that. So those will get hit hard when interest rates start to rise. And of course, after she said this, well, you know, the 10-year yield is, as you see, spiking hard.
And just to be clear, it's a rise in rates, not bonds. And that means that actually bonds are trading down. But so a rise in rates is the benchmark instrument by which all financial instruments are priced. The reference rate being the U.S. Treasury, 10-year Treasury bond. And what we've seen since Reagan's day was this extend and pretend. Like every single problem that came up in America, they would just float more bonds and extend the maturity. And you see this all over the world. Argentina recently did a 100-year bond. America's talking about a 100-year bond, actually. So it's just like, let's just push the problems into the future, and we're going to lower the interest rate, and the central bank will buy up all this paper itself. They'll debt monetization, it's called, and we'll never have to suffer the consequences. Well, the thing is, it's like you are throwing pebbles into a volcano, hoping that it won't blow up. You know, eventually the forces of nature assert themselves, and having central banks collude and take on hundreds of trillions of dollars of bad debt does eventually cause the earthquake of toxic risk to blow like Krakatoa and spread a cloud of risk globally, resulting in huge market chaos and a flight to hard assets like Bitcoin principally is benefiting from this, but also gold to some degree. Stocks, you know, they have benefited from the chaos and the money printing for 20 years. We could see some choppiness in those growth stocks that she is referring to.
Right. There will be fear. There will be fear. And she goes on to say in that interview, and it sounds to me a lot like what you've said here on Keiser Report before, because she said, now, one of the things that I found interesting over the last really 20 years is that the S&P's PE ratio tends to peak out in the 20 to 25 times range of forward earnings. And I think the reason for that is most portfolio managers and maybe quantitative researchers are looking at normalized nominal GDP growth in the 4 to 5% range, which is where long-term interest rates should be normalized. We actually think normalized GDP growth is probably closer to 3%. The growth is not there as much as what people think.
Look, this is the great irony in U.S. economics, is that they say it's a free market capitalist system, and yet there's no free market for money itself. The market doesn't determine the price of money. The interest rates are the price of money. The price of money is determined by really a Politburo of the Federal Open Market Committee, headed up by the chairman, who's currently Jay Powell, and they unilaterally, non-market, outside of the market, decide what they believe to be the correct price, this price fixing. You know, any country that attempts to fix the price of commodities within that economy always collapses. That's just history. The U.S. will similarly face the exact same result. You cannot have, on one hand, an economy that's free for autocrats and plutocrats and kleptocrats to use that free money to go out there and agglomerate most of the income-producing assets with very little risk, and pretend as if that is somehow fostering competition, right? That's like that underlying lie that is at the base of the entire Ponzi scheme, and it works until suddenly you lose faith in that Ponzi scheme, and like Bernie Madoff, one day it just blew apart. Or Enron, remember, it was going great for a few years, and then one day it just blew apart. Hyperinflationary collapse of the US dollar is happening right now against Bitcoin. It's happening right now, people. It's not on the news because it's scary. Like if you were to say, oh my gosh, there's a tsunami coming. And the people on the beach would say, that's too scary, so I'm not going to process that information. It's just too scary. And then they just sit there on the beach and they get swept away. Everybody who's not prepared for the tsunami of hyperinflationary collapse against the US dollar that's happening in 2021 will get wiped away as quickly as they did in the tsunami. The only escape valve, as Christine Lagarde calls it, is Bitcoin. She called it. I believe Christine Lagarde. She said, your escape from the catastrophe that I, Christine, created is Bitcoin.
Right, that catastrophe market that Mark Valek had mentioned in the last episode. And I just think it's interesting to observe that the two bluest, most elite states in America, California and New York, or it would be New York and California, two blue states, very democratic. They're seeing massive outpouring of people fleeing those states heading to Texas, in the case of California, or Florida, two red states, and no income tax states, and Florida and Texas. Of course, and New York and California have the highest income tax states. It's over 13%. If you live in New York City, it's even higher. So they're all fleeing those high income tax states suddenly. It feels like they know something's happening. Because they themselves, those elite in Manhattan and Los Angeles and San Francisco, they are the ones that created this situation. They know what they wrought upon the world, and they are fleeing to the places where they don't want to have to pay for the disaster that they themselves created. This is catastrophe markets.
Right, exactly. All the people that voted against the blue states are living in the states that all the blue states are moving to, so they're going to have to get rid of those people, even though those people in the red states knew this a long time ago and voted accordingly. The blue state people are going to be running in there and pushing them out and saying, wait a minute, we're the blue state people, even though you were right, red state people, in what you did the last 8 years and voted the way you did. We're going to have to push you out because we're the blue state people and we get all the tax breaks.
I think it's interesting to look at what people do rather than what they say. They will go on MSNBC, they will go on CNN and say, just like that guy from U2, Bono, he said, everybody should pay a huge amount of taxes and go save the world, except for me. but I'm good friends with your prime minister and your president, and I'm going to convince them on your behalf to raise your taxes but flee. Same thing going on with Manhattan and California elite. And it's you see it in the numbers, and there will be fear. There will be fear.
That's the question. How did Bono become a schmuck? All right. Well, we're going to take a break. And when we come back, much more coming your way. Welcome back to the Keiser Report. I'm Max Keiser. Time now to return to our conversation with Mark Valek of Incrementum. He's out with his annual Gold We Trust report. Mark, welcome back.
Hi, Max.
So BlackRock, the largest asset manager in the world, recently said that Bitcoin is displacing gold. From the numbers they see from their clients, young people are just not interested in gold. They're buying Bitcoin. Is Bitcoin eating gold's lunch, Mark?
Well, we do see a great trend into Bitcoin, especially the last few months. But still, I would not go so far to say that Bitcoin is demonetizing gold, as a lot of Bitcoiners like to claim. First of all, gold isn't monetized currently, so gold at best is a store of value outside of the fiat currency system. But going forward, I think there are a lot of people, look, for instance, in Asia or in the Middle East, who's so connected to the physical metal that I really don't think that these people will all sell their gold and just buy into Bitcoin. But I do agree that Bitcoin is an alternative and is taking perhaps some part of the market share for non-inflatable assets. But on the other side, one should note that this market is a growing market. We are in a negative real interest environment, so the demand for non-inflatable assets is growing. So it actually really doesn't matter medium term if Bitcoin outgrows gold. Gold can increase in value as well, since the demand for hard assets is structurally increasing.
Right. I should mention that over there at Incrementum, you've been involved with Bitcoin for a number of years. You have a fund, actually, that does some strategic trading in and out of gold and Bitcoin, trying to capture absolute rate of return. And you've really written brilliantly about it. And so you have a front row seat on how these markets are developing. Over there at ARK Invest, they're forecasting for Bitcoin a $6 trillion market cap, so 6x from current levels. By 2025, that's about 300,000 per coin. Some of this will come from displacing the dollar as a settlements layer, some from displacing gold as a store of value. Where you fall on that prognosis?
That's obviously quite bullish, but I wouldn't argue against it that much. I think that could be in the cards. That sounds quite realistic to me. But I think the market for non-inflatable assets will be growing a lot. So in 2025, I think the market cap of total gold will not be 12 billion anymore, like it's currently. It'd rather be probably like 20. So I could imagine some kind of a gold price between $3,500 or $4,000 perhaps in 2025. So again, Bitcoin may have outgrown the market outgrown the market share of gold. But gold's market cap will increase. I'm very convinced of that as well.
You know, we've known each other a long time. You know, we go back a few years. You recall our Crash JP Morgan buy silver campaign. It was an attempt to squeeze silver, squeeze JP Morgan in their silver position. And now here we are in 2021, and the Wall Street Bets Reddit crowd is suddenly put on this squeeze silver campaign to follow up on their squeeze GameStop campaign. There's a whole new movement out there with Robinhood traders and day traders. Is there any greater likelihood that there's a mass movement that could squeeze the shorts in silver this time and bust up kind of the oligopoly that keeps the prices low this time, do you think, Mark?
Well, first of all, silver is really a small market. Obviously, it's a much bigger market than GameStop, but in terms of the big asset class, it is a very small market. And the bullion banks do play a major role in that market. What I do like about this whole movement was, I think there was a big PR coup for silver as an investment, because a lot of these younger people were not really aware that silver could be an interesting investment generally. So people started to inform themselves what actually are the properties of silver and the investment cases. So silver in it of itself, in my view at least, has a very strong investment case for the next decade. So a lot of people may have realized that when they first stumbled over the silver investment case during the silver squeeze. I think that the first momentum obviously has stopped in the silver squeeze, but I think it could reignite. And I think regardless if this silver squeeze, as perhaps a lot of gold bugs, and I include myself in this category to some extent, think that could happen. I think silver will rise in price regardless if this short squeeze will succeed or not. The fundamentals are just extremely strong, so I wouldn't think too much about it if the short squeeze succeeds, but I would rather stick to fundamentals, and the fundamentals are really bullish for silver.
Similarly with gold, you know, it's been trouble getting gold to move. You know, we alluded to it in our previous conversation that other commodities they're moving higher. Gold seems to be lagging. And a lot of it has to do with exactly what you're saying there. The bullion banks have a vested interest in keeping the gold and silver price suppressed vis-a-vis the dollar. And so my question is, you know, they own most of the gold, or a huge percentage of the gold over there at the member banks and the Fed. Is it ever, what's it going to take to break gold free from the clutches of this oligopoly?
Loss of confidence at the end of the day. I think that's probably the final answer. When really the general public loses confidence in fiat currencies, and as we discussed, this is partly already taking place, but not to an extent which is really on a broad scale. So if prices, daily prices really rise so fast that people really need to get rid of the currency fast, then they will really use all kind of stores of values which they can get a grip of. And gold, as I said, will stay a part of the spectrum, a part of the viable options where one can store one's declining currencies. So this will need a little bit more, but it will come. I'm pretty sure gold prices will continue to rise.
Let's take a look at MicroStrategy, of course, headed up by Michael Saylor. He's done something with his treasury over there. He started buying billions of dollars of Bitcoin, loading up on this Bitcoin, also taking advantage of the near 0% debt that they are able to avail themselves to. Can you liken what they're doing over there to a speculative attack on the currency itself as it collapses? Again, going back to Weimar Republic, there's actually a lot of bankers who took advantage of the low rates that were on offer in a similar speculative attack that they profited from magnificently to become very, very rich. Another telltale sign of a Weimar-like Republic situation. Here's a guy, Michael Saylor, at a multi-billion-dollar corporation who says to the money printers, basically, I've got you in a trap. You're going to lend me at zero, and I'm going to attack your currency by buying Bitcoin. Wouldn't this be the game plan for a lot of corporations that want to escape the money printers and the Janet Yellen lunacies?
Yeah, I agree. I was very influenced by the book When Money Dies, which is exactly about the topic of the Weimar hyperinflation. And this book really extensively describes quite a few of these kind of cases which happened back then when people actually leveled up to buy real assets, commodities back then, for instance, or gold, but also industrial commodities, and real big fortunes were made during this kind of environment. So such an inflationary environment is quite an El Dorado, perhaps, for speculators at the end of the day. And yes, it gives a lot of opportunities to investors and speculators. But unfortunately, the general public loses out and is impoverished. That's the bad part of the story. But I really recommend everybody to perhaps read or reread this book. It's a magnificent book, and I think a lot of good learnings one can find there also for the times which are ahead.
So, I mean, to bring it all together, going back to our previous conversation, Janet Yellen thinks that there wasn't enough money printed last year, even though the money supply increased by 25% to offset the downturn of an imploding debt Ponzi scheme. And Michael Saylor looked at that and said, "You're out of your mind. I can borrow at zero, and I'm going to crash the U.S. dollar and all fiat money." If you look at the book, When Money Dies, where are we in the cycle in that book? How close are we to the point when, in the 1924, when you actually had that catastrophic 100% loss of purchasing power?
Well, I'd say the very big difference is that a lot of the capital, the real assets, actually were destroyed during the war. World War I obviously took a huge toll on the real industrial capacity. And although the current economic system is highly distorted due to this decade of zero interest rates, a lot of sectors were basically helped and subsidized, which perhaps shouldn't have been this big. Still, the industrial capacity right now is much higher than in 1921, 22, 23. So this is, I think, a difficult factor to calculate. But I think that's why also I'm a little bit skeptical that hyperinflation is around the corner. We do have parts of our economy which still are extremely efficient, and also obviously parts of the world, look at Asia, are getting more and more efficient. So the question is perhaps rather when will these parts of the world with really strong economies cut, for instance, the US of their exports, because then I think perhaps the US or importing countries generally will perhaps have a greater problem. And that may be the time when inflation really gets bad. So there are so many factors in there, but I think the 70 scenario has to play out. So 10, 12, 15 percentage points of price inflation. That would be the first step. And then things could go pretty fast. So the loss of confidence scenario can come rather fast if one is already in this kind of inflationary stage. But first we need to see these double-digit inflation statistics to come then to the hyperinflationary phase.
Right, Mark Valek of Incrementum. Last year, when you put out your report, people could get it for free. Is that going to happen this year too?
Yes, sir.
How do they do that?
You can download the report on www.ingoldwetrust.report, and it will be published in end of May as every year.
That's a fantastic report, and it covers Bitcoin as well. Thanks so much for being on Keiser Report.
Happy to be here.
All right, that's going to do it for this edition of Keiser Report with me, Max Keiser, and Stacey Herbert. I want to thank our guest, Mark Valek of Incrementum. Until next time, bye, y'all.